So emerging markets assets falling earlier today ahead of a couple of big central bank meetings this week. And now let's get to our guest, Lee Tianxiang, Senior Research Analyst at online unit trust distributor fund Supermart. So Tianxiang, we've got the BOJ, we've got the FOMC meeting end of this week. How are markets looking as we head into those key decisions?
I think if you're looking at all these weekly meetings, all this, right, then definitely you'll be getting into quite a string of bumpy ride in terms of seeing the markets going up and downs. But I think the best way for people to ride through all this is to have a very systematic portfolio constructions so that they won't be influenced by all this fear and greed emotional cycles whenever they are getting news from all these central banks.
Well, here's the thing, there is a greater reliance on central banks now. Some may argue that central banks may have increased volatility in the market instead of calming it. Now, you're saying in your note that volatility is here to stay and investors should embrace it.
Yep.
How are they going to do that?
So I think one of the things is before you even start to invest, you need to have a systematic portfolio, like I said just now. By saying that, for example, a risk profile that are more moderate style, you have 50% equities and 50% in bond funds. So that being said, it's like every time you see that equity funds are getting a dip, then it might be better for you to dollar cost average whenever there's some turbulence in the market. So
the name of the game here is still diversification.
Yes.
And defensive player, I suppose.
Yep.
Given your notes, you're saying construction sectors, property players. What is the outlook there for those sectors in the second half?
I think if you are, first of all, I think if you are looking at construction and infrastructure, they are still here to play. I think one of the key themes for the Malaysian investors are still to look into all those construction and infrastructure industry. So I think they are the major beneficiary of all those ongoing government infrastructure projects. So their earnings stability are still there. They are going to get a lot of awards from all these ongoing projects. Like said just now, we have the recently announced high-speed rail projects coming up. So they will also be getting a lot of job streams coming from all these projects.
Now here's what's interesting with property players. We did see that spike in share prices following the OPR cut. But soon after, we did hear from Ben Negara saying that lending rules there are to stay. So that 25 basis points not really moving the middle that much. But would you see any pickup in the property sector?
Yeah, I think for the property sectors, a 25 basis cut from the central bank will not be enough to spur the property market. Because if you are looking at the past history, the time where the interest rate is being cut significantly is during the global financial crisis. So during that time, our OPR rate is being cut by 150 basis points. So that's the point where the property market actually see a turnaround. But that's after a year of very easy monetary policy period. So this time around, like what Ben Negara said, we don't actually see a significant cut as compared to last time. So I think the strict lending standards will still be here to stay to actually curb all those speculative activities, but they will be skewed towards those people-centric measures, like giving a lot of support to all those first-time home buyers.
So in terms of exposure to property stocks, would you say affordable housing looking more exciting now?
Yes, definitely. I think right now, if you are looking on the ground, there's greater demand for all those affordable housing. So probably those they are liking those property sectors, they might be looking those property players. They are more skewed towards all those affordable housing segment.
Okay. Now I was going through your notes in the summary of the first half. Out of your top performing funds, gold-related ones as well as REITs were some of the best performers there. And given how the interest rate is still moving and central banks on an easing bias still, do you see more allure to both assets?
Yeah, I think if you are talking about gold, it's kind of very complicated because it's not just about supply and demand. It's also because of its special characteristic of being a safe haven asset. So right now, if you're looking at the market, like you said just now, central bank, they are moving a lot in the markets, causing a lot of turbulence. I think people like to have some stability. That's why they tend to plow in some portion of their monies into this asset. And if you're looking from our in-house view, I think that for REITs and gold, it's good for you to have some exposure to it because it's tend to be more stable when the markets are not doing very well.
Okay, and what about other asset classes that you are looking at?
Yeah, I think you're mentioning about alternate investments or you're talking about the traditional assets?
Well, when you talk about diversification, we mentioned equities, bonds, and you're looking at REITs. But given how you're expecting more volatility, and what are the asset class that looks best in terms of risk reward returns?
Yeah, I think right now, I think if you're looking at Malaysia alone, if you're talking about what's the strategy to ride through all this market, I think right now there's a lot of potential growth within the small cap segment. So there's a very cheap valuation as compared to large cap, and there's more potential growth in this particular segment. So one thing investors can do is to adopt a barbell strategy where they shift upwards to the riskier segment to invest a bit in the small cap segment, and also at the same time to be more conservative in their bond part. So they will be allocate more into their conservative or short duration bonds as precautions for preserving their capital.
And within that small cap segment, which sectors are looking particularly attractive for you?
Yeah, right now I think a lot of all those industrial sectors, industrial players, they are still a buy for investors because they are kind of cheap, and a lot of them are being ignored by analysts out there. Because like I said, a small cap segment, there's a lot of potential growth. So part of it is because they are small cap, because of their characteristic. Another thing is because they are much being ignored by analysts. So there might be some mispricing in terms of their asset prices. So this will provide a lot of alpha for investors if they are keen to explore more into all these segments.
Okay, and how about commodities here? I mean, we're seeing oil back to 44. Given it has somewhat stabilized, would you see oil and gas perhaps as one of the areas that you might be looking in the second half?
I think if you're looking at oil and gas, we don't have a very strong conviction on oil and gas sectors. But if you're looking in the local domestic front, then you realize that a lot of oil and gas sectors, the counters there, they have been battered quite heftily. So it's averaging from negative 40% to 70%. But I think those they are having.
So are values emerging now in oil and gas?
I don't think so.
Not
I think
yet.
there's still value out there if you are looking for other opportunities.
Okay, all right. Thank you so much. That was Lee Tian Xiang, Senior Research Analyst at Fund Supermart for his